how are you approaching property assets right now from a fund manager perspective?
Well, the credit market has been laser focused on the property market risks for months now. What I do want to point out is that this pilot property tax rollout, which just came out recently, will bear some impact on the market amidst the already weak consumer buying sentiment and demand, which is critical for the entire property sectors to accelerate the cash recovery to delever. And the details of the property tax implementation has not been crystallized yet. It perhaps go, the pilot city by city or province by province rather than a universal policy. Therefore, the longer term impact is yet to be seen. But one thing, perhaps for certain, is the buyers would wait. And however, there's not all bad news. The home appliances, housing services, and property service providers has been hit hard as they are related to this overall concern. And after a hefty valuation correction in some of these names, they could become attractive because their growth is not only driven by incremental housing demand, but also driven by existing lifestyle upgrade. So we are looking at those names as a potential opportunity to scoop up. But we will remain to be very cautious about the credit market related to property names.
Okay, so that takes us into equity then, because the way you described it, interesting, is that you mentioned that some of these related sectors could be attractive enough from a valuation perspective. Do you think we're close to those valuations, or are you still cautious?
Well, one can never predict, is this an absolute bottom 6 o'clock or you're still at 5 o'clock, right? So I think to take carefully dipping into the position might be the way to build it.
When it comes to just the sentiment, though, it seems like it's shifting a little bit more to the positive side when it comes to the regulatory overhang in markets, whether it's in property, whether it's in tech. We had a guest from JP Morgan earlier saying, look, this rally that we're seeing seems to be justified. Do you subscribe to that view, too?
Well, I think the offshore market saw some recovery in these names, but this recovery, I wanted to caveat that not only sectors or names that has a severe valuation correction, but also they need to have quality with a strong balance sheet, with sustainable growth, even if the growth stepped down, but still sustainable growth, and which will not suffer foundational business model alteration. And these are the conditions to look at the peaks. It's not a universal, single-sided recovery yet.
Okay, so what pockets do you actually look for when it comes to, that could potentially be shielded away from the massive earnings downgrades that we're seeing in China right now? What are certainly some silver linings that you're seeing?
I would give healthcare as an example. People are overly concerned about the central government procurement program, but for innovation drug companies in biotech space, I think they will be relatively more immune to the purchasing programs pricing pressure, and that's a place where we're looking to. And some of the internet platform companies as an infrastructure to the economy that we're also looking to.
Earnings season is here. Hundreds of companies are set to report results. Vanessa, anything particular you're watching?
Well, for the China market earnings, we still watch very big earnings dispersion. It's inter-sector and intra-sector. So again, the market is going to be choppy, and perhaps the contrarian managers will do better than the growth buyers.